Welcome to the session, and in this session we are going to focus on gross domestic product, which is also known as GDP, and what are the different uses of GDP. The first question which arises is, what is gross domestic product? You must have read a lot about it in the newspapers. The newspaper always keep on reporting the level of GDP and what is the growth rate of GDP in our country. So why there is so much of importance being given to this GDP? Why its growth rate is so important? So we need to understand all these facts. So if we talk about the definition of gross domestic product, its definition is it is the sum total of market value or monetary value of all the products and services provided or rendered in boundaries of a country within a specific time period. So what essentially GDP is, let's take the example of India. If for a year we measure what is the market value or the monetary value of all the products and services which are being produced in our country. Products, let it be any product, any FMCG product, a textile product, or a electronic product, if it is being manufactured in our country. Or let's take any service like the services provided by airlines or the services provided by banks. So we need to take the market value or the monetary value of all of the products and services which are being produced in our country within the boundaries of our country for a specific time of period. Let's say 1 year. So we just have to sum up the monetary value of all the products and services, and we will get the value of gross domestic product. Now, gross domestic product is the scorecard of a nation's economic health. How the economy is performing of any country. We can get a very good idea about any country's economy by having a look at its GDP and also the growth rate of GDP. So we need to know the aggregate level of GDP, which is the sum total of market value or monetary value, and we need to know the growth rate in the GDP. How much the GDP has grown in the current year compared to the previous year. So basically, we can say that if the GDP is increasing, if there is a positive growth rate of GDP, then the economy is growing. And that is a very good news for that country, because whenever the economy grows, the living standard of the citizens of that country goes up as well. Lot of unemployment is reduced. Lot of people get jobs. So whenever the growth rate is high of GDP, it is a very good thing for the economy of that country. It is an indicator. The growth rate is actually an indicator of the economic health of a country. Higher the growth rate, the better it is for the country. Now, in GDP, whenever we are calculating the GDP, we need to also look at the imports and exports made by the country. So, whenever we talk about import and exports, you should have the idea about two terms. First term being trade surplus, and second term being trade deficit. Let's talk about trade surplus. What is trade surplus? Trade surplus is excess of exports over imports. That is the trade surplus. Let's suppose if in our country we in a particular year export 100 million worth of goods and we import 80 million worth of goods, then the 20 million, which is the amount by which the exports are more than the imports, the 20. So whenever the imports are more than the exports, we get a situation which is known as trade deficit. And trade deficit is the result whenever the imports to our country is more than the exports. And opposite of trade deficit is trade surplus. When does the country has a trade surplus? When the value of imports is less than the value of exports. So we now know what is trade deficit, what is trade surplus. So whenever there is trade surplus, whenever there is trade surplus, it causes an increase in the GDP, and whenever there is a trade deficit, it leads to a fall in the amount of GDP. And whenever we are trying to calculate the GDP, so we can calculate the GDP on two bases. First basis being the nominal basis and second basis being the real basis. So let us first of all understand what is the meaning of nominal basis, and then we will move to what is the meaning of real basis. So first of all, I'm going to explain to you what exactly is the GDP which is being calculated on nominal basis. Now in the nominal basis, the prices that we take in calculation of GDP is including the inflation. So whenever the prices increase, that is known as inflation. So when we are trying to calculate the GDP, which is the gross domestic product, we are including the inflation during the calculation of GDP. Let me just explain it with an example. Let's suppose that in a country there is only a single product being produced and the total units of that product produced in the country within 1 year is 100 units. And the price per unit of that product is rupees 10. So if I ask you what is the GDP of that country, if in a country only a single product is being manufactured and in 1 year 100 units are being manufactured and sold at rupees 10 per unit, then the GDP of the country will be rupees 1000. Now let's suppose that the prices increase due to inflation and the price of the product is now increased from rupees 10 to rupees 11. The production remains the same, 100 units. Now what is the GDP of the country? It is 1100 rupees. So we can see that there is an increase in the GDP. The GDP has grown. But is it real? The answer is no, because only the prices of the product has increased. The production of the product has not increased. So this is a real limitation of GDP, which is calculated on nominal basis. And by nominal basis, I mean taking the prices present in the economy, including the inflation. Like in this example, we have seen that the price was rupees 10. It increased to rupees 11, leading to an increase in the nominal GDP, but the production has not grown. So this is, although we can say that the GDP has increased, but on real basis, the GDP has not increased. It is just the prices of the product in the country has increased. So this is a problem because we want that the GDP should tell us about the economic health of the country. And if only the prices are increasing in the country, the production is not increasing, then that is not real economic growth. So to tackle this problem, what we do is we calculate the GDP on real basis. That is, we adjust the amount of GDP with inflation and then we arrive at the figure of GDP. So real GDP is a better measure of economic growth of the country as compared to nominal GDP, because nominal GDP includes inflation and real GDP adjusts the GDP for the inflation. That's why real GDP is a better indicator of economic growth. Now let me just explain to you how we can calculate the real GDP. Over here in this particular slide, you can see that the production remains the same, 100 units, but the GDP has increased. This is the nominal GDP. Now, to arrive from a nominal GDP, if we want to calculate, if we know the figure of nominal GDP and we want to now arrive at the figure of real GDP, then we have to use a concept which is known as GDP price deflator. So basically GDP price deflator adjusted the GDP for the inflation rate. Now how is this GDP price deflator calculated. Let's say that the prices in the country has increased by 10%. As we see in this particular example, when the total production was 100 units and the price was rupees 10 per unit. Now the price has increased from rupees 10 to 11. So the inflation rate is 10%. The prices of the product has increased by 10% over the price of the previous year. So if in the previous year the price was rupees 10, it has increased by 10%. Now it has become 11 rupees. So what we will do is, now our nominal GDP is rupees 1100 and we want to arrive at the figure of real GDP. So how we can calculate the real GDP? We can take the nominal GDP divided by the GDP price deflator, which is 1.1. Now how we have arrived at this figure of 1.1? 1 plus the percentage increase in prices, that is 10%. So if we calculate it, we convert it into a number, it will come out to be 1.1. In the same way, let's suppose that I'm just explaining it to you, the calculation of GDP price deflator. If the inflation rate is, let's say, 20%, then the GDP price deflator will be 1.2. If the inflation is 25%, the GDP price deflator will be 1.25. In the same manner, over here we know what is the GDP price deflator, 1.1. So we divide 1100 rupees by 1.1 and we get the real GDP, which is 1000. Now earlier the GDP was rupees 1000. Now the real GDP is again coming out to be rupees 1000. So the GDP has not grown in real terms. It has only grown in nominal terms. In real terms, the GDP was 1000 rupees a year ago. Currently, the GDP is again 1000 rupees. So there is no growth in GDP. Now we know what is real GDP and nominal GDP. Let's look at one of the most important concepts relating to GDP, which is gross domestic product per capita. And this is calculated by taking the GDP of the country divided by total population of the country. This is how we calculate the GDP per capita. That on average basis, how much of GDP is being contributed by one individual in the country. That is your GDP per capita. And this GDP per capita can very easily be calculated on nominal basis, on real basis, and also on purchasing power parity basis. In the media, always they talk about GDP growth rate. There is always reporting going on around what is the current GDP growth rate, what is the expected GDP growth rate. And so many reputed organizations like the World Bank, the International Monetary Fund, and also the finance department of the country, the finance ministry of the country, they always keep a check and they always release the data of the expected GDP growth rate. What will be the GDP growth rate in the future? Now, the GDP growth rate, what it is? The GDP growth rate is a measure of how much an economy has grown in the current year compared to the previous year. So we need to compare the GDP of the current year with the GDP of the previous year, and we need to see whether there has been increase in GDP, which is positive growth. Whenever the GDP increases, there is positive growth, or whenever the amount of GDP has reduced in the current year compared to the previous year, then there is negative growth. So for a country, the good news is when there is a positive growth in GDP, the gross domestic product is increasing. So it may happen that the per capita income of the country is also increasing. And if the per capita income is increasing, then the standard of living in the country is also improving. So the GDP growth rate is a popular metric to measure the speed of economic growth of a country. How fast the economy is growing. Let's say if India is growing at 7% and China is growing at 5.5%, because India's GDP growth rate is 7%, we can say that India is growing at a faster rate as compared to China. So higher the GDP, the better it is for the country, and we can compare the GDP growth rate of different countries and arrive at the conclusion regarding which country is growing the fastest and which country is growing the slowest. We just need to compare the growth rate of GDPs of various countries. Now, since every country is striving, every country's government is trying to achieve positive growth in the GDP, sometimes, in spite of the best efforts of the government, that there is negative growth of the GDP, which means that the country is in recession. Recession means whenever the GDP has a negative growth rate, whenever it is reducing. To combat the problem of recession or to combat the problem of negative growth rate, what can a country do? It can reduce the interest rates in the economy and also announce a stimulus package so that the country can move from negative growth of GDP to positive growth of GDP. So the what can happen? What can the country do if it is in recession? The central bank of that country, like in our case, the Reserve Bank of India, what they can do is they can reduce the bank rate. Whenever the bank rate will be reduced, then the companies will find it more cheaper to take loan from bank and expand its business. And whenever the companies present in the economy are expanding their business, then the country may very well move from negative growth of GDP to positive growth of GDP. And also, along with the reduction in interest rate, these days a lot of countries come out with a stimulus package. Stimulus package can be, for example, that the country's government is going to spend an additional 1000 crore rupees. Government is going to government is going to increase its budget, and they are going to spend 1000 crore rupees on various activities. So this 1000 crore rupees can be said to be the stimulus package. This 1000 crore rupees has been specially announced and will be spent so that the country can come out of recession and go back into the phase of positive growth of GDP. Now, to calculate GDP, we have three approaches. The first one being the expenditure approach, the second one being the production approach, and the third one being the income approach. So, in the expenditure approach, what we do is we try to find out the various parties in any country's economy, how much they are spending, right? So, what was the total consumption of the country? What was the total money spent by the government? What was the investments made in the country? And how much is the net exports? So if we add these four headings, we will get the GDP. The second approach of calculating the GDP can be the production approach, in which we look at the total production in the country and what is its value. So we take the total value of goods produced in the country and we subtract from it the cost of all those goods which were used to produce the final goods. So all the goods which are being used to manufacture other goods are known as intermediate goods, and their cost is reduced from the total volume of goods produced to arrive at the figure of gross domestic product. The third and the last approach to calculate GDP is the income approach. In the income approach, what we do is we try to we try to sum the income of all the individuals in the country so that we can arrive at the figure of GDP. So we take interest which is being earned on capital, we take rent which is paid for land, we take profits, and we take salaries. So we add the interest received, the rent, the profits, and the salary to arrive at the figure of GDP. So I hope that now you have a good idea about what is GDP, how it is calculated, and why GDP is so important, and what is the importance of GDP growth rate. Thanks a lot for listening to the lecture. Thank you.